Hi, my name is Sue White. I'm a teaching professor at the University of Maryland in College Park, and I'm here today to talk about capital budgeting. What I would like to talk about today is first the capital budgeting process. Capital budgeting is what a firm does when it decides which projects it's going to accept. The firm has to look at what investment opportunities that it has and then decide which ones are good investment opportunities, which ones should the company pass on. All the time remembering the goal of the firm is to maximize shareholder wealth. The firm maximizes shareholder wealth by maximizing share price. The firm maximizes share price by choosing all possible positive net present value projects. So first, let's look at the things that go into the capital budgeting process, and I'm going to go over all of these in a lot more detail. First, the company needs to find projects. If a company can't come up with good investment opportunities, it's not going to stay in business very long. Now, this is obviously a very critical part of the capital budgeting process. Textbooks tend not to spend a whole lot of time on finding projects. Textbooks are going to spend a lot more time on analyzing those projects. But keep in mind, if a company doesn't have good projects, it's not going to last very long. Once you've found some projects, the next step is to figure out what are the relevant cash flows. You have to figure out what cash flows matter, what cash flows don't matter, what is the timing of those cash flows, and set up the cash flows in an appropriate timeline. Then, once you've got a set of cash flows, you need to decide what is the riskiness of this particular project. You've got a timeline. You want to discount those cash flows back to the present day, and to do that you need an appropriate discount rate. So I'll be talking about cost of capital and how to figure out what is the right discount rate to use for those projects. Then, once you've determined, okay, these are the projects that we have, then you've got to decide what's an appropriate capital budget. Does the company have all the money that it needs? Is it able to raise all of that money? Now here, finance theory says if you've got good projects, no problem. You can always raise the money you need. But we'll see in the real world that isn't always the case. And then finally, the last step, here's another step that textbooks don't spend a whole lot of time on. Once you've chosen a project and you've started that project and implemented that project, you need to go back and say, was this really a good project? Were revenues as high as we thought they were going to be? If not, why not? Were costs as low as we thought they were going to be? If not, why not? And if it turned out to be a good project, how can we duplicate it and do more of it? If it turned out to be not so great a project, how come? And how can we avoid making this mistake in the future? Next, I'm going to talk about the kinds of projects that a firm could do, and also talk about what are the cash flows that are going to go into these projects. Often a firm will classify projects as replacement projects, where it's simply buying new equipment to replace already existing equipment, or the firm could have expansion projects, where it's doing more of the same thing. Or the firm could have a brand new project, where it's entering into a business that is new for the firm. As you can imagine, there are different risk levels associated with these kinds of projects. Replacing a machine might have the lowest risk level and therefore the lowest discount rate. Expansion projects are going to be pretty much the same discount rate that the company has been using, and they might need a slightly higher discount rate for brand new projects, for areas that the firm hasn't entered into. Let's look at the cash flows, and I'm going to go over some general categories and then go into a lot more detail about how to determine actual numbers for these cash flows. Some of the general rules to look at in determining cash flows: first, use actual cash flows, not accounting flows. What this rule is referring to most of the time is depreciation. When a firm buys capital equipment, the IRS does not allow the firm to expense that equipment immediately. The firm has to expense the equipment over the useful life of that equipment in the form of a depreciation expense each year over the useful life of that equipment. Well, that depreciation expense isn't a real cash flow. The cash flow occurred back in year zero when the company actually bought that equipment. So what happens here is that the company is taking a paper-only expense, not a dollar expense. However, it's an expense. Anytime there is an expense, that's going to impact taxable income. The more expenses you have, the lower your taxable income and the lower your taxes. So depreciation is an expense that's going to impact taxes. And taxes, as everyone knows, taxes are a real cash flow that you have to be concerned about. So what we'll be doing in the cash flows is subtracting depreciation expense to figure out what taxable income is, subtracting taxes, and then when we have net income, we'll be adding depreciation expense back in again. The next thing you need to make sure of is your timeline. Make sure you are having the expenses occur when they occur. Again, we don't care about what the accounting rules are, we don't care what the IRS says. We want to make sure the cash flows are occurring in the timeline when the company actually had the expenditure or actually had the revenue. So very important to make sure you've got a correct timeline. Now, next, opportunity costs. When a company uses a resource, whether that resource is money or land or equipment or a building, whenever the company uses that resource, there's a cost associated with it. If they were not using that resource for this particular project, what else would they be doing? What else could they be doing with the money? What else could they be doing with the land? What else could they be doing with that building? So often there are opportunity costs associated with projects. What else you could be doing with that particular resource? Opportunity costs are relevant and need to be considered in the cash flows. Next, taxes. Taxes are always a relevant cash flow. The government wants to get its cut, so the company needs to figure out what are the relevant taxes associated with a project. The next area, sunk costs. With sunk costs, this refers to any cost that has already been made, any money that has already been spent. The rule in capital budgeting is that if you have already spent that money, that cost is not relevant and should not be included in the cash flows. Accounting overhead. This is very important to look at all the costs and say, would you be having that cost anyway? Or is this a new cost associated with the project? To give you an example of this, when I was teaching at the University of Texas, I had some guest speakers come in and talk about their capital budgeting process. They were in the business of supplying online and brick-and-mortar travel agencies. And in their cash flows, they had their salaries, the finance function salaries, and various other overhead expenses. And I said to them, why are you including those? Capital budgeting theory says that these expenses are not relevant and should not be included. And they said, oh yeah, we know that. We know that these aren't relevant. We're including it to make the marketing department work harder, to make them strike better deals so they can have more profitable projects by giving them these costs that they really don't have. As finance people, you know that something that is accounting overhead, something that you would spend anyway, is not relevant and should not be included in the cash flows. And then finally, financing costs. Financing costs should not be included in the cash flows. Interest expense, dividends, principal repayments, anything related to finance should not be included. The reason behind this is that most of the time we are going to be discounting free cash flows using the weighted average cost of capital. The weighted average cost of capital includes financing costs. It includes the cost of equity. It includes the cost of debt. It includes the weights of debt and the weight